Katie, great to have you here. We have the market. Look, it's acting pretty resilient. Again, we had an opening drop, and then we've clawed back to the flat line. But overall, this rebound rally we've seen from those lows in early April, it's definitely impressive. Is it convincing in your mind in terms of, does it mean that we are resuming an uptrend?
I would say the short answer is no. Because usually when we see these violent relief rallies, they're more often found in bear market cycles. So that's the bad news. But the good news is we are almost back to where we started, almost a round trip. So we have this nice 23% gain over the last few weeks for the S&P 500. And it's given us what I feel like is a bit of a gift. For stocks that have broken down, people now have an opportunity to reduce exposure into that strength.
So you would be more inclined to look for something to sell up here because you think the overall market is vulnerable to backsliding?
We are generally in that kind of sell into strength mode, and we're still comfortable holding core long exposure. We like that long exposure right now to lean more defensive, both on the sector front and even outside of equities on the asset class front. But the high-flying tech stocks, in fact, most of the stocks that exhibited upside leadership off of that April low, we would imagine will probably exhibit downside leadership, just that high beta nature. And that's going to include most of the mega caps, including Microsoft as one example. A great move from Microsoft. It's right up near its highs again. But it does have, as of today, a counter trend signal, the first of its kind since the rally began. So with that gap that we saw in Microsoft a couple weeks ago, it does start to feel overextended.
There is this sense out there, and it's the way the market seems to act, that it just feels as if there's just a lot of money that feels left behind by the rally, and maybe there's just this catch-up instinct out there. I know a lot of the analyses of institutional positioning shows them having been very, very underweighted stocks. Maybe that's back toward neutral now. But I wonder what the evidence is telling you about whether we've seen a culmination type move, right, in this rally, because sometimes there are things to look at that say, okay, we've kind of squeezed all we can out of this rally.
We like to look to the VIX to that end. The VIX is a great transactional gauge of market sentiment, and I would argue that the VIX, being inversely correlated to the S&P 500, is now on support and quite oversold, showing some signs of stabilization. In fact, this morning we had a little bit of a gap up that I'm sure you noticed. That gap up does hint at a shift in volatility, a shift in market sentiment that is more likely to yield a pullback in the S&P.
And can you handicap in terms of whether, are we going back to the former lows if we do lose this bid, or is it just kind of we have to chop around?
I would say that we have a good chance of going back to the lows. I can't assign a probability, but when you refer to the monthly charts, the monthly indicators, things like the MACD, which is very popular as a trend following gauge, these are pretty new sell signals. So they have implications for the most part through year end. And it would be hard to imagine that the bear market cycle that we think is underway is going to have already culminated with that April low. So we're mentally preparing for a lower low. If we see signs of downside exhaustion arise above that level, that'd be great. Our initial support for the S&P 500 is just shy of 5,500. That would be, like, to me, best case scenario. Would love to see that. I think more likely is a return to an important Fibonacci zone of support, which is closer to 51.25.
Yeah, I know that is a pretty widely watched area. You mentioned some of the higher octane, higher beta stocks that did lead off the low. The inverse of that, I guess, is some things that look like they really got overdone to the downside. UNH is bouncing today. I know you've taken a look at that. What does it look like to you?
That's right. And listen, healthcare even more broadly has really taken a beating, especially in relative terms. And all of the pharma names, a lot of the big biotech names like Amgen, Regeneron, they look really oversold. And it goes both in absolute and relative terms. We highlighted a counter trend signal today in UNH. It's not for the faint of heart to buy it necessarily into this weakness, into this big downdraft, but for a relief rally in relative terms and for the most part in absolute terms in the healthcare arena, I think it seems very likely. And it would be natural if you think about it as associated with the pullback in the S&P 500, where you do tend to get that more defensive sector positioning.
And is healthcare where you would look if you felt as if you wanted to shift back toward defense at this point?
Right now, I'd say from a short-term perspective, it's definitely high on the list. I wouldn't say I would limit exposure to that. A lot of these names still look pretty terrible from a technical perspective on their long-term charts. They have not established basing phases. But if you look at Johnson & Johnson, even Merck and Pfizer look pretty oversold, and they do show some indications that they should release themselves from their doldrums.
Just a quick word on the bond market. 10-year Treasury yield, do you have a target?
Well, we do think it can reach about 474. That's a resistance level. It's a strong resistance level, but looking for more choppiness, really more of a neutral